Richard, when yields go down, you actually have two options, right? The first is to have a really good discussion with your client, saying this is the reality, this is where it's going. What is your risk appetite? Some investors have actually followed the route with us in saying, well, we may need to be a bit more realistic with our return expectations. Some of them have actually lowered their expected return, but saying no compromise on quality. We're happy to lower our expected return. You tell us where that level should be, but you need to tell us what kind of quality real estate we'll have at the end of the day. And is that preserving my capital value at the end of the day? Others would say, listen, we actually could take a bit more risk. We don't need the cash flow right now. We have a young pension fund. We have a long duration or horizon. And we actually can take some time where we can support some forward funding. But similarly, no compromise on quality. You have to tell us what we will be building for core or building for prime, and tell us what kind of proportions we would build into that. And going back to Guillaume's point, we wouldn't advise today chasing yield, sort of the bird in the hand fallacy, where you actually think you have a 6.5% yield with a 3.5 residual, weighted average lease length, and then at the end, you're back, bang smack on with the next recession, the down cycle, and your value has just been destroyed. So to answer your question, we do find a number of attractive opportunities in building prime or building core, or accepting low income yield but with assets that have optionality. So in 5-6 years time, you can actually convert those assets into something that has much more value, either by changing the use or because changing the nature of the asset because of technical or physical capacity to undertake the asset management initiatives. So there's a whole host of options, and actually if you stick to the what we call the DTU rich cities, rich in demographics, rich in technology, and rich in urbanization, you actually have a pretty high optionality in building those portfolios. But these are the cities such as Paris, London, Hamburg, Munich, of course. But I would probably stay away from taking those risks in much more secondary locations that are not supported by demographics in particular.
I would agree. You don't have to move up the risk-return equation necessarily. You don't have to take more risks. I think one of the dangers we saw in the last down cycle was the profile drift which happened. Yeah. People said, I want to build a core portfolio in the gateway cities of the US, and suddenly they found themselves buying dodgier assets in tertiary locations. And I think that drift mustn't happen. You have to define very clearly what you want, and then manage expectations as much as risk, and then manage expectations of the investors with regard to the actual risk-adjusted returns you produce. That's, I think, the best safeguard from drifting into a territory which is then going to hit you afterwards.